For topic 20, hybrid financing, preferred stock, leasing, warrants, and convertibles. Preferred stock is a hybrid security with features of common stock and bonds, paying fixed dividends like bond interest. It's listed as equity on the balance sheet but sits between debt and equity in finance. Preferred stockholders receive priority for dividends but don't have voting rights. For basic features, preferred stock has a par or liquidating value of $25 or $100. 1 peso is the minimum par value here in the Philippines. For example, Ayala Corporation issued 150,000 shares of 100 peso par value perpetual preferred stock several years ago. Each share pays a fixed annual dividend of 12 pesos. At the time of issuance, the required rate of return in the market was 12%, and the stock was issued at par value. Recently, due to the lower interest rates and Ayala's strong financial performance, the required rate of return for preferred shares dropped to 9%. This shows how falling required returns can raise the value of fixed dividend securities. If the preferred dividend is not earned, the company does not have to pay. However, most preferred issues are cumulative, meaning that the total of all unpaid preferred dividends must be paid before dividends can be paid on the common stock. Unpaid preferred dividends are called arrearages. Second is adjustable rate preferred stock, where dividends change based on the interest rates. During the 2008 financial crisis, issues is auction rate market caused liquidity problems for businesses, leading to lawsuit by 2011. In recent years, about half of fixed-rate preferred stock has been converted into common stock, showing changing strategies by companies and investors. Preferred stock has its advantages and disadvantages. For advantages, preferred stock offers several advantages for companies, including avoiding bankruptcy if dividends aren't paid, reducing ownership shares of common stockholders, and putting less pressure on cash flow compared to paying back loans or bonds. Its lack of a set-end date and spread repayment requirements also prevents bankruptcy. And for disadvantages, including non-tax deductible dividends, making it more expensive than debt after taxes. Investors expect dividend payments, treating them as fixed cost and adding financial pressure similar to debt. This increases risk for the company and can raise the cost of issuing common stock as companies can skip dividend payments. For the second topic is leasing. Companies acquire fixed assets like buildings, equipment, and vehicles through buying or leasing. Leasing has evolved from real estate to all types of fixed assets, with global leasing value reaching 1 trillion by 2016. Now, the global leasing value was 1.9 trillion. However, many lease agreements are not included in companies' balance sheets, making it challenging to understand their full financial obligations. There are 3 types of leases. First is sale and leaseback. A sale and leaseback is a business model where a company sells a property and leases it back to a buyer, such as bank, insurance company, leasing firm, or investor. The company receives cash from the sale but still uses the property as security, similar to a loan. Lease payments are based on agreed terms, unlike mortgages. Second is operating leases. Operating leases, also known as service leases, are used to lease equipment like computers, cars, or office machines, often including maintenance and support. Popularized by companies like IBM, these leases don't cover the full cost of equipment, but the owner plans to cover the rest through renewals, leasing, or selling the equipment later. They often include a cancellation option for early termination if the equipment becomes outdated or unnecessary. Last is financial or capital leases. Financial leases, also known as capital leases, differ from operating leases in that they don't include maintenance, cannot be cancelled, and are fully paid off over time. The lessee chooses the equipment and agrees on the price with the manufacturer, while the lessor buys the equipment and leases it to the company. This lease is similar to a sell and leaseback, but with new equipment purchased directly from the seller. Financial statement effects. In the past, companies listed lease payments as expenses on their income statements, hiding leased assets or debt on their balance sheets, known as off-balance sheet financing. This strategy helped companies appear less risky or financially strong, enhancing their financial statements. This table shows the balance sheets of two firms before and after a 100 assets increase. Firm B finances the increase through debt, increasing its debt ratio to 75%. Firm L leases the asset, leaving its debt ratio unchanged at 50%. This illustrates how financing choices affect a company's balance sheet and debt ratio. For the evaluation by the lessee and lessor review a lease agreement before making a decision. The lessee compares leasing cost to buying the assets, while the lessor ensures a good return. Despite the complexity of lease deals, a standard step-by-step process and focusing on the lessee's perspective helps make the right choice. When a company acquires a building or equipment, it determines its worth and profitability. To pay, they must choose between borrowing money, using profits, selling new stock, or leasing. Leasing is often viewed as similar to taking a loan, especially under accounting rules, as it impacts the company's finances in a similar way. NVP analysis. This table performs a net present value analysis comparing the cost of leasing versus purchasing equipment. It considers the initial cost, annual maintenance, depreciation tax savings, salvage value, and lease payments, all discounted to their present value at a 6% interest rate. The analysis concludes that leasing is more advantageous, resulting in a net advantage to leasing of $446,000. The decision is based on the lower present value of costs associated with leasing compared to purchasing. Other factors that affect leasing decisions. As it says on the evaluation by the lessee, the estimated residual value is lease evaluations involve both the lessee and lessor assessing the deal, with the lessee comparing leasing cost to buying the asset and the lessor ensuring fair returns. And for increased credit availability, new rules limit the benefit of leasing for smaller companies by only allowing short-term operating leases to stay off the balance sheet, reducing the chance for companies to hide lease obligations, as larger companies already report most of their leases. For my third topic is warrants. A warrant is a long-term option that lets someone buy a company stock at a fixed price within a certain time. Companies usually give out warrants along with bonds to make the deal more attractive to investors. This way, they can offer lower interest rates on the bonds because the warrants adds extra value. For initial market price of a bond with warrants, for example, the initial market price of Jollibee Foods Corporation's bond with warrants is 1,020 pesos. This amount is composed of 920 peso for the bond itself based on comparable bonds without warrants and an additional 100 pesos for the value of the attached warrant, which gives investors the right to buy Jollibee shares at 250 pesos. The higher total price reflects the added benefit and potential upside of the warrant, making the package more attractive despite a relatively low coupon rate. For the use of warrants in financing, small, fast-growing companies use warrants to make their debt or preferred stock more attractive to investors, allowing them to get lower interest rates and fewer conditions. Warrants act as a mix of debt and equity, allowing investors to buy stock later at a fixed price, usually 15 to 30% above the market price. They are typically used when stock prices are high, dividend increase, or exercise price is set to increase. For the component cost of bonds with warrant, for example, Jollibee Foods Corporation issued 500 million worth of 10-year bonds with a 6% annual coupon rate to raise capital. Each bond priced at 1,000 pesos included a detachable warrant allowing the purchase of GFC common stock at fixed price. The estimated market value of each warrant was 20 pesos. To compute the net bond, 1,000 minus 20 pesos is equal to 980 pesos. And then the after-tax interest is 60 times 1 minus the tax rate, which is 0.30, is equal to 42. I use the cost of debt formula, which is after-tax interest divide net bond, and 42 divide 980 is equal to 0.0429 or 4.29% per bond at the end of year 10. For my last topic, problems with warrant. Although warrants are bought by investors with the expectation of receiving a total return commensurate with the overall riskness of the package of securities being purchased, things do not always work out as expected. So this is my example of problem with warrant of Ayala Corporation. In 2016, Ayala Corporation raised 6 billion through 5-year bonds with warrants, offering a low of 6.5% interest rate. The warrants let investors buy shares at 900 pesos, but by 2021, the stock dropped to 820 pesos, making the warrants worthless. As a result, Ayala missed out on expected equity funding and had to refinance the bonds at a higher cost, showing how market-based financing can backfire when stock prices fall. So that's it for my report. The next one to continue this topic is my partner Daniel John Hassan. Thank you.